Accounting equation and Excel. Reversing entry for unearned revenue or customer deposit. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation with Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil if those things even still exist. If you do have access to this workbook, though, 5 tabs down below. The example tab, in essence, the answer key, month 1, first month of operations, month 2, second month of operations, practice tab having pre-formatted cells, so you can practice the practice problem with less Excel formatting, the ADJ and reversing tab, the one we will be working in, where we started with a blank worksheet but are basically working within a template now. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to that example tab to get an idea of what we will be doing. Remember, we're basically building our bookkeeping system using the accounting equation as, in essence, our trial balance from which we will and have constructed our major financial statement reports: balance sheet, income statement, statement of equity. So thus far, we've entered 1 month of data input, closed it out, second month of data input, then created our adjusting entry worksheet, and now we're working on the reversing entries part of our adjusting entries worksheet, noting that we want to keep separate in our mind the bookkeeping or accounting process and the adjusting process, even if we're the same person doing the same process, although often that is not the case because often the external CPA firm, public accountant, or whatever is going to do the adjusting processes oftentimes, noting that the accounting goals are to communicate with customers, vendors, employees, and automate the system as much as possible so as little focus as needed is done or focused on the accounting process, more focus on the money generation, revenue generation process. Whereas at the end of the year, most likely end of the year typically, we need the adjusting entries at least at the end of the year so that we can format our financial statements more closely to whatever financial reporting basis we're using, whether that be accrual or at the least a cash or a tax basis for our tax preparation needs. So we're imagining then I would take the information out of QuickBooks, or even if I had access to the software, make my own worksheet, usually using debits and credits, but here using the accounting equation so we can see in a more transparent way the adjusting entries, and possibly we can map out the reversing entries as well. And then possibly put that back into the accounting system, keeping in mind and trying to think about which of the adjusting entries are permanent, which of them are timing differences, the ones that are timing differences being ones that typically have reversing entries, because the timing difference that, or the timing frame that the accounting department is using or bookkeeper is using is not wrong. It's just not perfectly on the basis that we're using, accrual basis in our case, or tax basis, or whatever it is. So we want to make it the adjustments at the period end to make it correct for financial reporting purposes, but then reverse it so that we don't mess up the accounting department. That's what we're basically working on at this point in time. So this time we're going to be reversing the adjusting entry we did for unearned revenue. So let's go back up to the unearned revenue just to recap the adjusting entry we did. Didn't I color code it? There it is, unearned revenue. Now, quick recap on unearned revenue, usually and often being the most confusing adjusting entry, in part because a lot of businesses, possibly most businesses, do not have unearned revenue because most businesses are going to do the work either before they invoice the client or before they get paid, or at the same time they get paid, such as in a cash register type of situation. And therefore, you're not going to have any unearned revenue, which is a result of getting paid before you do the work. And remember, our classic examples, the ones that are probably still in textbooks even to this day, even though it's somewhat antiquated, are like a newspaper, right? So nobody buys the newspaper anymore except if out of tradition, because it's basically worthless at most of them, basically worthless at this point. But if by tradition you like to have someone throw that thing at your house, and no longer a kid on a bike, some creep in a van driving around hired by the news organizations, of course. They probably hired directly. You have to live out of a van in order to work for the newspaper delivery. Anyway, if that's the case, then obviously you sign up for the newspaper beforehand, and then you pay the newspaper company so they get paid before they actually do the work. And then once the creepy dude in the van throws the newspaper through your window, that's when they earn their revenue, right? And so you have to basically then take it out of unearned revenue, recording the revenue when the work was done. Now, more modern examples of that would typically be like any kind of subscription model for, say, software. So if you're in a software company and people are paying you for the use of the software, they're usually going to be paying you before they use the software for a year's subscription or something like that. You collect the money, which means, again, you didn't do the work. So therefore, it shouldn't be going into revenue when you collect the money, even though that would be the easiest cash-based thing to do, but rather going into a liability of something like unearned revenue. And then, which I believe is this one, unearned revenue. And then once you earn the revenue by providing the software, then you're going to take it out of unearned revenue, decreasing the liability, recording then the revenue. Now, remember, the book problem, classically, that makes sense from just an accrual standpoint, because the idea would be, hey, look, what I'm going to do is I'm just going to keep on recording every time I get paid. I'm going to put that into, instead of revenue, unearned revenue. And then periodically at the end of the month or the end of the year, I'm going to look at all the subscriptions that I had, possibly determining how much of those subscriptions I have earned the revenue for, how many newspapers were thrown through the window, earning us the revenue. And then I will determine how much to reduce unearned revenue by and how much we should increase and move into the revenue account. That makes sense from an accrual basis, but from a practical software basis, we have the added problem of the subledgers. The subledger for customers is not usually tied to a liability account of unearned revenue. Now, some software, like a Xero, for example, tries to integrate, in essence, the unearned or prepayment from a customer so that we can properly record it as a liability while still pulling that information into the subledger related to the customers, which is usually tied to the general ledger account of accounts receivable. So, but even that is still a little bit more complex, because you can see what's happening. The subledger is now representing two general ledger accounts instead of one, which again is a little bit wonky, because you're going to have to take it out of the unearned revenue and move it to the accounts receivable, at some time, for example. Some software like QuickBooks still, although QuickBooks is thinking or has been toying with some other options that will be similar to the Xero solution, but it's almost easier to say, all right, from a software perspective, what I want to do is keep all of the customers in accounts receivable. Therefore, when I receive a payment, if it's a subscription model, for example, before I actually do the work, I'm going to record it as a payment form, which is a form in QuickBooks usually designed to decrease accounts receivable. That's what it does, right? It's going to decrease accounts receivable. The other side goes into unearned revenue or the checking account, for example. But normally it's tied to an invoice. That form automatically, you would think, is always tied to an invoice, the invoice usually being entered before the payment form. But in our case, we're going to enter the payment form before the invoice, resulting in a credit balance in the customer account. It's going to look wrong on the financial statements because it's going to end up with a negative receivable. Note, not the total receivable isn't negative in the general ledger, but if I look at individual accounts over here in the subledger, I'll note that some of those individual accounts may have a negative balance. And that's going to be because that would indicate that we owe them money, not they owe us money, which is the case because they prepaid us. We're not going to give them money. We're going to give them, in the newspaper example, a newspaper through their window for their efforts. Thank you very much. Here's a newspaper through your window. And then this creepy guy in the van just keeps circling the block too, which is kind of disturbing. I kind of wish that wasn't going on. But in any case, so where was I? if we have these negative balances for a particular customer, we can just shore that up at the end of the period by generating the customer report, looking for the negative receivables, and then basically increasing the accounts receivable by that amount, and then putting the other side to not revenue, but to the proper liability account. So in other words, the software oftentimes these days can handle the tracking of how much of the revenue has basically been earned or not, because I can receive the payment and I can basically record the payment, and then I could record scheduled invoices that will automatically invoice the client monthly, for example, in accordance with the subscription. So that's not usually the problem, although that's still kind of the issue on a book problem side. The software usually handles that. The problem from the software side is the subledgers, because you get this messy business with the subledgers. So again, it oftentimes is more simple to use one subledger that has a negative account and then just shore it up at the end of the year by doing adjusting entry if needed, noting that small businesses might not need to ever do an adjusting entry, because if you're just reporting the income statement on, say, a tax return like a Schedule C, there's no balance sheet. So you don't really need to do the adjusting entry unless you need to do external reporting. You need to report the income statement, and the income statement should be reported properly using this method. So we're going to imagine in our case, we had to report the balance sheet either for external reporting purposes like to the bank to get a loan, or for investors, for example, or possibly for our internal decision-making use. And therefore, we did an adjusting entry at period end to basically record the liability. So that's where we stand at this point in time. So now we're going to have this liability of unearned revenue on the books. And we don't really want that to be the case. That's going to confuse possibly the accounting or bookkeeping department. Now we could just say, hey, look, just leave it there. It's okay, because we dumped it into an account over here. Oh, by the way, one other thing on the subledgers. When we enter this into QuickBooks, for example, I'm not going to be able to enter it as a journal entry without affecting the subledger, because QuickBooks and many software like Xero force us to have a customer involved every time we post something to the accounts receivable account, because it wants to force us to have a subledger that ties out to the general ledger, which is usually a good internal control. However, it backfires for us here because we would rather not do that, because what I want to do is do an adjusting entry, which will throw the subledger off, but I'm okay with that because I'm going to reverse it right after, putting us back to where we need to be. So I'd rather just hit the general ledger and not touch the subledgers at all, because that's going to mess up the accountant. So in other words, if, for example, there was a deposit for Mr. Anderson over here and they had a credit balance and I had to adjust for it, when I do the adjusting entry, I would do a journal entry because I want all my adjustments to be journal entries and not invoice forms. But then I'm going to see, and the bookkeeper is going to see this journal entry, which is funny to see in the subledger. We don't usually see that type of form in the subledger. Usually they only see invoices and payments. So that's going to mess them up, right? And so when they communicate with the customer, it's going to mess them up. So what we did instead, we could make another account called accounts receivable 2 or accounts receivable adjusting entry, for example, and then and make it not an accounts receivable type account, so that the software doesn't force us to have a subledger. However, that's a little bit messy in software like QuickBooks, because I can't put those two accounts together and I can't make them a sub account because they're two different account types. Account software like Xero actually does allow us more flexibility, even though they're different account types, to group them together, because they have a kind of a more sophisticated customization of their reports. Although with more sophistication of the reports comes more complexity in order to use them. So there's pros and cons in that. So the other option is to say, look, I'm not going to report it in Mr. Anderson's account because I don't want to mess him up. So I'm going to make another account for the customer called ZZ customer. So it's at the bottom of their customer list if they have alphabetical order that they're using. And then I'll just post all of my adjusting and reversing entries into there, hoping that although I'm going to enter them in as a journal entry form and not an invoice and payment form, which typically link together nicely, that I'll still be able to link together the journal entries in the software so that when I run reports for open items per customer, it doesn't show this one customer with a ton of journal entries that haven't been closed out or couldn't be linked to each other because we have these open journal entry forms. All right, so that's the idea. Let's do it then. So I'm going to go back to the adjusting tab, and it's just going to be on 3/1. All of our reversing entries are the day after the adjusting entry. So our adjusting entries, unlike normal, which would normally be 12/31, December 31st, ours were entered on 2/28, and then the next day is 3/1, unless there's a leap, whatever, unless it's a long year, 2/28, 2/29, you get the idea. All right, so where's the adjusting entry? Here's the adjusting entry. And then we're going to say, okay, this is going to be a reversing entry for unearned, we'll put this down here, revenue. And I'm just going to bring the same dollar amount. So obviously I'm just going to do the opposite of what we did here. It was 450, so I'm going to bring that down. So 450, I'm going to say then accounts receivable is going to go back down. What did we do with the adjusting entry? We increased the accounts receivable because it was understated, because it was showing payments from customers for which there was no invoice yet because we got paid before the invoice. So now I'm going to put it back to where the accounting department had it, and we're going to say it's going to go back down. And then the other side is going to go into the unearned revenue. So note, like if I didn't do this reversing entry, I could just tell the accounting department, hey, look, just don't worry about that 450 in there in unearned revenue. We will adjust that again next time, next period, next year, or next month, or next quarter, whenever the next adjusting process is. But again, it's probably better just to reverse it so that they don't even have the question, right? So we could just put it back to where it was before, so they don't be like, what are you doing, man? What are you doing? All right, and so then we'll put some zeros across the board. Zeros across the board. Zeros across the board. It's kind of unfortunate, but you know that it's like in a construction site, when you have two different people working, you've got the framers and then you got the electricians and the whatever and so on. The next crew always blames the prior crew for any problems, right? That happens in any kind of business, right? So if the bookkeeper has a strong incentive to blame the to blame the person that did the taxes or the adjusting entry, sometimes that's not all, So you gotta try to make that communication as clear as possible, so that you don't end up in that situation. But in any case, so notice we put the 450 up here. So there it is, and we're gonna reverse it now. And so this is gonna be equal to the decrease, boom. So now we had this one and this one are going to tie out. Now note that normally if you saw this, you would think, oh, well, there's an increase. That should be like an invoice, and the decrease should be like a payment. And that normally would be true. But remember that if this was, and this only matters if you're in the software, because we're recording it basically with a journal entry. So you're seeing the bare bones of the transaction. But in software, you would use forms, which are data input forms, not necessarily forms you give to people, right? And so the form, so the fact that we're not using a form, or you can say that the journal entry is the form that we're going to use instead of an invoice and a payment, is why we put it into this new customer account, so that again, I can match those two out. It's going to look funny, but I should still be able to tie them out, hopefully, so they don't show as outstanding on reports, right? And so then this customer hopefully will just be hanging out at the bottom of the customer list, maybe even make it inactive, but it's not going to be having anything in it after we match everything out. It's kind of a clearing account for the customer. All right, I'm going to copy that down. So our balance is now at the 22,176. That should tie out to what's in the AR after we adjust this. This minus this is the 22,176. Let's put an underline across the board. Underline. We're going to go to the Home tab, Font Group, underline. Let's bring down the balance, baby. Bring down the balance, baby. Then my assistant's like, don't call me baby. I'm not bringing down the balance if you call me baby. I'm like, dude, it sounds cool to say baby when you say balance, baby. Balance, baby. It's not like, no, okay, oh no, the human resources is on the email. I'm going to have, dude, it sounds cool, okay? That's the only reason I said it. It sounded cool. Bring down the balance, baby. That's not a reason, they say. That's not a reason for being crude like that. Dude, whatever. It is so a reason. If you want to sounding cool is important. No one wants to listen to you if you don't say cool stuff. They don't agree with that. I'm going to copy this down. You don't have to be cool in the accounting department. You have to be cool in the accounting department. It's important. You got to say stuff that has alliteration in it. Anyway. So we're back in balance. So notice again that this reversing entry is not something that is a classic adjusting and reversing entry, because we don't have the timing difference here, meaning there's no income statement account involved. And it would be involved if you had the classic book problem. But again, remember that the book problem gives you the theory of why you have a liability involved with the prepayment, but it's not actually giving you oftentimes what is the practical problem in real life, which is the subledger situation. So remember, what you want to do in practice then is always be thinking, is this a type of industry that's going to have this prepayment type of situation? Is it a subscription model? Is it a situation where they have customer deposits, like in a rental company or something like that, or any kind of rental situation? And if it is, then make sure that you look in and say, well, how does this company deal with the prepayments? Is it being recorded as an unearned revenue when they get it, or is it a negative receivable? And whatever they're doing, or are they incorrectly accounting for the revenue when they get paid, and they're not properly on an accrual system? Is that going to be a problem for taxes? Maybe not, because in some cases the tax code would like to get paid. They would like their money when you get paid, right? So the fact that you record the revenue when you get the money might be what the tax code wants, of course, because they want to get paid sooner. So then that's another question you want to be thinking. It's like, okay, if these prepayments are involved, how do I have to report that for taxes versus accrual reporting and so on? And just take that into consideration, of course, when you're picking up new clients, because it is an added level of complexity. I've had clients, by the way, before I really understood this subledger situation, when I had more of book accounting knowledge, and it drove me crazy. That was like, what are these negative amounts in the accounts receivable? This doesn't make any sense. They did something wrong. There's a problem here. They messed up their bookkeeping. I didn't understand, and then it took me a while to kind of figure out what they're doing and why, So when we come out of if you come out of a school setting, or if you're working with someone that comes out of a debits and credits setting and not as experienced with working with software, for example, then you're going to have, again, the communication becomes important so that everyone knows what's going on.